This video outlines some thoughts on trading, and in particular, a liquidity providing approach to making money. The overall message of this video is that trading should be viewed as a business. Perhaps we could end the video on that, but it's worth spelling out precisely what is meant by that idea. Overall, the message that I want to put across is that we want to provide a service to a customer base that we can charge for. The payoff is a repeatable, recurring income stream. It would be easy to be downbeat on trading and despair the current market conditions. New capital regulations for dealers, for example, makes it harder to apply the techniques that worked in the past. Fortunately, we do not have to hope that the market reverts to how it was 10 or 20 years ago. Technology has provided opportunities and approaches that, if properly used, deliver even better results. A good question to ask is, what are the main themes that will dominate the market going forward? The first is the requirement for quantitative expertise will increase. The second is more prices will move to an exchange, meaning that pricing needs to be constant, consistent, and correct, as well as profitable. Capital requirements will be more onerous, which in turn means that our pricing needs to be based on the marginal cost of capital. The approach outlined in this video is on the right side of these trends. We should aim to provide the counterparties liquidity in exactly what they care about and offer it when they want it in a consistent, efficient, and repeatable way. And to prove we are worth trusting from a fiduciary standpoint, we make a two-way to show the price is at the market. The observation can be made that 5 years ago, traders needed to be X% programmer or quant. That X% is higher now, and 5 years in the future it will be higher still. This leads to the main requirement of this approach. We need to get our hands dirty with respect to using technology. The classic approach to markets grows from the idea of all assets having a level of risk premium and a position in them allowing the holder to earn that risk premium. In this current environment of illiquidity and cost of holding risk, making money is much more to do with the price you buy at, when you buy, and what's going on in the rest of the world. While there are clear regulatory differences between being an end user or being a dealer, I'll blur that difference in this video. The aim is ultimately how one can provide liquidity profitably to counterparts in a way that currently is not available, and furthermore, uses only resources that are available to both types of market participant. The first issue to tackle is the reduction in liquidity since the financial crisis. This reduction is evidenced anecdotally from market participants and more formally from reported trading volumes. Given the scarcity of liquidity and hence demand for it, it's logical to adapt to a model that suits that scarce product, which in this case is liquidity provision. As well as increasing transaction costs, there is an obvious and key problem with operating in a market with limited liquidity. The classic modular approach to trading is one of gathering data, performing some maths or analysis upon it, which in turn culminates in a view or trade, and then determining an entry point, target, and stop for that trade. On a regular basis, one would reassess the data, and any conclusions made thereupon from it establish whether any material change has occurred that causes one to reevaluate whether to adjust targets or even exit the position. In an environment of liquidity, it's possible to exit the trade at this point. The opposite is the case in the current illiquid environment. Merely providing liquidity because it is scarce is not the only reason for a liquidity providing approach. The market structure is changing to make this approach more compelling. The original setup for financial markets was centered around clients or end users trading with dealers, and the dealers in turn warehousing the risk until they were able to unwind the risk with other clients. Charging clients on both sides of the transaction, effectively renting out balance sheet generated revenue to allow dealers to take proprietary positions in the market. The increase in capital charges for holding risk affected the economies of this trade, making dealers less willing or even able to hold risk for long periods of time. The limiting case of this pressure is that dealers become only willing to take on risk when the exit to profitably unwind the risk exists already, effectively becoming like clearinghouses. The revenue profile necessarily morphs from being a principal to being a broker, but without the buffer of commission. The winners in this new configuration are end users who are able to make a price for any risk at any time and hence provide liquidity to other end users nominally through dealers. The dealer should aim to retain this position as liquidity provider, albeit while optimizing the usage of capital. In the absence of continuous liquidity, the dealer is presented with three options. 1. Being profitable. 2. Showing prices continuously. Or 3. Showing tight fixed bid-offer spreads. The dealer has the choice of two, and only two of these three options. Providing tight fixed bid-offer at all times likely means taking the other side of all trades, which has scope for serious P&L downside. Choosing profitability and tight fixed bid-offer requires the ability to decline showing prices where market levels are mispriced or offer an arbitrage. However, by not quoting, there's a risk that the liquidity provider is not seen as a reliable or consistent counterpart, and hence will be unlikely to be on anyone's call list, which would limit trades done. We'll return to this later, but we determine that the ability to trade and maintain trading relationships is critical to making money, especially when adopting a liquidity providing approach. If we choose profitability and the requirement to provide continuous prices, we come with the outcome that we are able to adjust the spread of prices we show. This is the setup we should aim for. We should aim to always show two-way prices, but be able to vary the bid-offer spread as appropriate. Active trading and focused risk in the right products will mitigate the need to widen prices. The ability to determine the right bid-offer spread requires the usage of technology in order to process the required information and distill it quickly and correctly. This setup is the liquidity providing approach. The announcement that one wants to provide liquidity to dealers will likely generate a guarded response. Dealers being offered liquidity by other market participants will protest that the conventional setup is that they should be alone providers of liquidity, and as such they should be able to charge appropriate bid-offer spread for that service. The counter to this is simple. They are correct, but both of us providing liquidity should not be mutually exclusive. As a liquidity provider, we should offer the following terms. We will provide a firm two-way market. The counterpart is under no obligation to show direction. The counterpart is under no obligation to counter, or under no obligation to trade. The aim is to move to develop a trading relationship through offering a clear, measurable service. The service is the cornerstone of creating a business, where we can offer a service to our customers and are able to charge for that service on a recurring basis. The biggest hurdle for any successful trader is how they repeat that success in subsequent years. Making money on a recurring basis is a better profile than a lumpy one-shot deal, and this recurring profile is the one captured in a liquidity providing approach. Scalability is the next step once a successful approach has been developed. The classic approach to scalability is taking a strategy that works in, say, 50 lots, and then attempting to repeat the strategy in 500 lots. Often, though, the market does not allow this increase in size. One will quickly determine the optimal trading size for a strategy, whether one articulates that as notional per trade or overall risk position. The better approach to scalability is to consider what other markets the approach might work in. For example, an approach that works in US dollar investment grade CDS may also work in European investment grade CDS or US dollar investment grade bonds. We scale up by applying our working liquidity providing approach to other markets. We also can anticipate that trends that are observed in one market may be applicable to other markets. There are two types of businesses: those that exist in an environment with perfect competition versus those that manage to command some type of monopoly. The definition of a monopoly in this case is earning some significant percentage of the total value available, irrespective of the total size of the value available. We want to control a market completely and branch out from there rather than be a minnow in a huge ocean. In the latter, we'll find ourselves constantly faced with new challenges as we face hundreds of competitors for the same goal as ours. Hence, we take care in selecting the precise niche that we want to provide liquidity in, and from that point, fully invest in being involved in as many trades in that area as possible. Once a position has been entered, the only way to manage the profit on that position is by trading the position around. Actively trading one's position is the only way to gain an advantage or control your P&L in a way that has not been determined by the randomness of the market. We want to trade. Not trading is like not raising in poker or not moving your queen in chess. A key part of a liquidity providing approach is that we will be trading extremely actively. We want to make deals, and we want to be easy to do business with. If other market participants get the impression that we are going to make unreasonable demands, they will trade with other counterparts, leaving us out of those trades, meaning we get nothing of value while they benefit. The goal in the trade is not to significantly come out ahead over our trading partner, but to outperform anyone who isn't our trading partner. Consequently, a trade where both parties benefits sets up the next trade. Our business model for trading involves having a customer base that we continually provide a service to that we can generate recurring income from. Active trading means you are much more alert to market stress and can add or adjust risk at the correct level. We take profits early. We incentivize people to trade. We unwind risk when there's demand. Rather than look for a specific opportunity or single path to success, we assess all opportunities available and cherry-pick the best. This is perhaps the most important part of the video. We should not fixate on trying to put a particular trade on at a particular level. The odds are stacked against success in this approach. Instead, we look for all opportunities that are currently offered to us, that the other side wants to do, and we pick from those the ones that work for us by offering terms where they also make sense to us. An approach that works well in markets comes from combining an understanding of relationships and flow with a quantitative and technology-oriented approach. Many participants are purely quantitative, which is a valid approach, but will neglect the basic factor that price action is driven by human perception, and this market microstructure approach will create opportunities that are a blind spot for those who are purely quantitative. As a liquidity provider, we can articulate this simply. We have the technical backup to make prices quickly and accurately, but we use our market knowledge and our sales skills to get the trade done. One of the main criteria for choosing trades is determining the time horizon over which the trade should work. In this regard, we establish that we only care about trades that work on a very short time horizon or a very long time horizon. We avoid the middle, as that is a graveyard. Trades that are estimated to work over a 2 or 3 month horizon fall apart quite simply because there's no guarantee of liquidity at that point in time. The long horizon is important, since we're assuming that we are going to be the only liquidity provider. We have to choose rates that will work from a P&L, capital, and risk perspective in the scenario that we are the last person to trade that position. Making a diversified portfolio is difficult. Even though risk can be taken in different products, the trader will often have a consistent underlying macro narrative. This makes it much harder to have truly uncorrelated risk. This basically means it's much more likely that one unplanned market event will cause losses across all positions. Say there are 8 or 9 positions in a diversified proprietary book. If one of those trades collapses, that's around a 10% hit to risk capital. We'd much prefer risk in 90 names, where an error accounts for only 1% of capital. This is a volume of positions that we should expect to accrue as a liquidity provider. In addition, we value and price each trade such that we'd be happy to add it to our portfolio on its own. No trade is a hedge for another. It must stand on its own merits. This means we have no restriction in taking it off when the opportunity arises. Assuming also that we have a book of 8 discretionary separate positions, each day we need to assess those trades in the light of news, market moves, and our own understanding of what might be happening going forward and how it would affect those positions. If that process takes half an hour per trade, That's a total of 4 hours every day committed to reviewing yesterday's risk. This is before we try looking for new uncorrelated risk. This schedule seems unrealistic on a practical basis. Scaling into risk offers a huge advantage as a liquidity provider. We set up trades so we can keep adding to risk as terms become more attractive without breaching our risk limit per trade. Hence, while we may buy at successively lower levels, we only need a partial retrace of the market to make all of our money back. Also, we can segregate each additional increment of risk and trade it around while other positions might be initially underwater. As we book profits, we pull the overall trade into profitability. We want to contemplate how our book looks and how we manage it. The fundamental question is how it performs in different scenarios. This can be reduced simply to, we want to make money if nothing happens, and we want to make money if there's a blow-up. This can be more precisely expressed as wanting to be long and short a straddle. The problem with this payout structure is that it often sits below the x-axis of profitability. By charging bid offer on trades and trading a lot, we generate a revenue stream that raises this W. A simple diffusion model would look for identical movement in lots of individual instruments as evidence of a bigger overall sectoral move, or judge sectoral moves on the basis of whether the majority of constituents of that sector were moving in a similar way. More simply, if 80 names in an index of 100 names are making new highs, then it's reasonable to assume a bigger shift is underway. It's very difficult to perform this analysis on fixed income data, given the inherent poor granular quality. Most fixed income data is based on closing curves. In the absence of trading a particular tenor, most traders will apply a parallel shift to close. This means that when we perform statistical analysis, even if the data has no gaps, it's found to be unreasonably highly correlated. However, by being a liquidity provider, and hence actively trading, we record actual trade points, which, as well as being verified, are non-public. The proprietary information that 70% of single name curves are seeing flattening trades is a great indication for the direction of the overall index. Hence, this active trading strategy based on liquidity provision gives us non-market information for predicting much bigger moves that we can put risk on or fade as appropriate. One classic approach to StatArb includes finding a set of conditions that, if met, will result in making money. The approach usually consists of looking for previous breakouts and finding conditions that existed at that time. One conclusion may be to assume that if these conditions are met again, then another breakout may be observed. This falls down for obvious reasons. Breakouts are rare. Let's say that they occur 0.1% of the time, and usually happen in situations of stress. Let's say that we noticed that in 90% of breakouts, swap spreads were wider by 4 standard deviations from their mean. We can also say that generally this occurs 1% of the time. A typical strategy might be to look for swap spread widening by 4 standard deviations as a trigger for a breakout. The question is, what is the probability of there being a breakout if swap spreads are wide? The rarity of breakouts means that over 10,000 days we might only see 10 breakouts. Of those, 9 times we saw swap spreads widening by 4 standard deviations. Of the 9,990 non-breakout days, we observed swap spreads being significantly wider 100 times and within normal tolerance 9,890 times. Hence, in the 9 plus 100 cases of swap spread widening, only 9 corresponded to an actual breakout. This corresponds to around 8% chance of success in predicting breakouts given swap spread widening. The moral of the story is that predicting rare events is not made significantly easier, even if we have on the face of it reliable tests. The number of non-event days and the occurrence of false positives drowns out any signal. This is why historical date-based StatArb is not an obvious area for making money, even though it seems ripe for mathematical analysis. The liquidity providing approach eschews this method of fixating on a particular trade and dashing ourselves against the rocks of trying to get it on and managing it. Additionally, even if criteria could be established where a set of conditions would yield an 80% chance of success, little can be done to account for the scarcity of those conditions occurring. Waiting a year for a single trade to occur is vastly inferior to having a coin that is weighted 60% to heads and flipping it 1,000 times in terms of overall revenue generated. This again relates to the active trading profile from a liquidity providing approach. Any trading endeavor will likely try and generate revenue streams from a variety of techniques, including, for example, directional, mean reverting, algorithmic, and relative value. The common threat to all these approaches is a reduction in liquidity. In this situation, the opportunities offered to a liquidity providing approach increase immensely. While it's likely that a directional strategy, if timed correctly, will generate much more revenue than a liquidity providing model, the liquidity providing model will generate revenue in normal market conditions and complement the directional strategy extremely well in times of stress. There are only two ways of generating money on a consistent basis. One, adding value, or two, removing pain points. By providing liquidity for market counterparties, allowing them to exit less liquid positions, which in turn reduces their cost of capital and reserves, we reduce their pain points. By allowing market counterparties avenues of liquidity, permitting them to take on more business, which in turn we can provide further liquidity to, we add value. Hence, a liquidity providing approach to trading is an example of a way to generate money on a consistent basis.